Good morning and welcome. Thank you very much for joining us this morning. My name is Cameron Farrer. Joining me this morning is Neil Brown, Head of Private Equity at Federation Asset Management. Federation is a private markets firm, specialises in investing in businesses that meet a social and economic need in three main channels: private equity, real estate and renewables. And of course, it is the renewables section that we will be focusing on this morning. As mentioned earlier, Neil Brown joins me. Neil is a founding member of Federation. He has more than a decade's experience of investment management and corporate advisory services across a wide range of sectors, including energy, infrastructure, transport, and real estate. Neil, thank you very much for joining us. Please take it away.
Excellent. Thanks, Cameron. Good morning, everyone, and thanks for joining us. Today, as Cam mentioned, we're discussing the renewable energy sector in Australia, what Federation is doing in the space and why. So I'll start with an overview of the Australian renewables market itself and why it represents an attractive opportunity of scale, and then turn to Federation's recent activity and ongoing strategy for the sector. So perhaps to set the scene, there's a huge amount of investment required in electricity generation to replace capacity that will come out of the system over the next 2 decades. And renewables are best placed to do this with private equity style returns for those that can develop and deliver those assets to the long-term, low cost of capital infrastructure investors who seek to own those assets over the long term. And this is the segment of the market that Federation is looking to attack for its investors. When we talk about renewables, we mean energy produced using resources that are naturally replenished, with wind, solar and hydro being the most well-known and prevalent of those sources to date. Our focus at Federation has initially been on wind generation through the purchase of wind farm developer WindLab, and we're focused now on building out its sizable portfolio of developments and adding additional platforms over the medium term. So turning to the market on slide 3, there's a real need for construction of new generation capacity in the National Electricity Market, or the NEM. The NEM is the market that's connected by the large electricity transmission lines across the eastern states. So it includes Queensland, New South Wales, Victoria, South Australia and Tasmania. And the development of this new generation is not a case of overbuilding surplus capacity, but a critical need for new capacity as Australia's coal generation fleet reaches the end of its useful life and is retired. And this is a phenomenon that we've already seen occurring, and this will continue to occur. So for example, the Flinders Power Station, which was down in South Australia, was a large power station there, retired in 2016. Hazelwood was a 1600 megawatt station, a large station located in Victoria that was retired in 2017. And a further 15 gigawatts of capacity is coming out of the system over the next 2 decades, which can be seen in the chart to the bottom left of the slide. Next on the blocks is the 2000 megawatt Liddell Power Station. People might have seen that in the news. It's an AGL coal-fired power station in New South Wales, which is expected to come out in 2023. And more generators are reaching the end of their lives in Queensland, Victoria and New South Wales over the next 10 years. And so to put that in context, perhaps the entire capacity of the NEM is around 50 gigawatts. So 15 gigawatts of that capacity retiring, 30% of the capacity is a really material amount that needs to be replaced in a relatively short period of time for long life assets. And indeed, that 30% of capacity by the amount of actual electricity generated is something like 60% of the electricity generated in the NEM. So it's a really material amount of electricity generation capacity that needs to be replaced. And so turning then to how best to replace that capacity, renewables are the logical source from an economic perspective, and also superior, of course, from a carbon perspective. But even leaving the carbon aspect aside, the solar and wind are the logical source just from an economic perspective to replace that capacity. And how we think about that is with reference to what's called the levelized cost of generation, or the levelized cost of electricity. And that's a concept of how much does it cost per unit, or what price is required per unit of electricity generated by a generator in order to cover the cost of its operations and the cost of building that capacity over its life cycle. So it includes a concept of ongoing operating costs and fuel costs, for example, and also the return of the capital that it takes to build that plant initially. And so you can see in the top right chart there, solar and wind are already the cheapest on a levelized cost of generation basis over the life cycle. The dark blue bars represent the position in 2020, and the lighter green bars represent the expectation in 2040. And so it's for this reason that 90% of installed capacity by 2040 is expected to be in renewables. The pace of the rollout will depend in particular on wholesale electricity prices and investment in the transmission network. Further improvement of the grid will help a greater penetration of renewables to come more quickly into the system. The issue with renewables is that they aren't on all the time. Clearly, the solar generators are only on when the sun is shining, and the wind generators only work when the wind blows. And so to provide the certainty of enough supply or availability of electricity when it's needed, a combination of renewables and gas generation, fast start gas generators, so those that can turn on quickly, so when the wind stops blowing, the gas generators can turn on, is the medium-term solution until storage solutions like batteries reduce in cost and replace the need for any of the fossil fuel generation. So turning to slide 4, this page illustrates why there is an opportunity to expand renewable generation capacity and also why it can be done profitably. So these charts are a little complicated, but bear with me. They're attempting to demonstrate how the intersection of supply and demand sets the price of a unit of electricity at a particular time of day. And so perhaps in the top chart, what the charts show is what's called the short-run marginal cost of each type of generation. And so the short-run marginal cost is just the price required, the operating costs of the generator to produce that 1 unit of electricity. And so in the case of the thermal generators, the coal and gas generators, predominantly that's the cost of the fuel that needs to be burnt to create that unit of electricity, but also the variable costs associated with running that plant for that period of time. And so that's what's called a merit order or a bid stack. You can see the lowest short-run marginal cost is towards the end of that chart, and the highest short-run marginal cost is on the right-hand end of the chart. And so you can see there that because solar and wind have no fuel costs, then they're the lowest short-run margin at the left of the chart, and the costs increase as you go through the various types of generators, through the coal generators and then up to the gas generators that are more expensive. The price is then determined by where demand for electricity, shown here by the vertical dotted lines, meet the supply of electricity. So similar to any other market price setting mechanism. And so you can see at average demand, It's the coal generators that are setting the price at their short-run marginal cost at maximum demand or peak demand. These are the peak periods when we all arrive at home in the evenings, for example, and turn on appliances and the like. It's the gas-fired power stations that are setting price and setting the price of electricity at a much higher cost. And so each generator that's cheaper than the price-setting generator on that chart receives the clearing price. And so the generators to the left of the chart make the difference between the clearing price and their own short-run marginal cost as profit for generating that electricity. Looking at the bottom chart, this is then the picture in 2040. You can see, I guess, to take from that chart is the fact that the amount of coal generation, so the brown and black bars, have reduced significantly over that time and have been replaced by renewables in storage. And the average price resulting at that time is a levelised cost of generation, a price for the electricity that is profitable for renewable generators relative to that levelised cost of generation that we saw on the previous page. So we saw the levelised cost of generation on the previous page for solar and wind around $50 a megawatt hour. You can see that as the average prices increase above $50 a megawatt hour, then the renewables are not only getting a sensible return on their capital, but really making good profits for generating there. So that's my summary of the market. I might just pause there to check if there are any questions.
There has been a couple come through, Neil.
Okay.
Yep. So one on battery. You mentioned solar and wind, but is battery the solution to removing fossil fuels from the fuel load?
Certainly storage, either chemical, which is battery storage, or mechanical, which can be pumped hydro. So pumping water up to the top of a hill and releasing it is a form of storage. And there are other new technologies that can provide storage capability. Certainly, I think in the long term, as the cost of those batteries and mechanical storage solutions become cheaper, effectively you can think about those as adding to the levelised cost of generation chart that we saw on the previous page. As we stand today, the cost of batteries is not economic relative to the combination of a solar or wind generator and a gas-fired power station. And so right at the moment, that's not a fix-all solution to replacing the capacity. But over time, we see technology curves where the cost of technology reduces over time as the manufacturers of that technology build scale and the technology improves. So, we see, like has happened in solar and wind generation, the cost of that capacity coming down over time. And so I certainly expect that over time, as battery cost continues to decline, that becomes the sensible, long-term solution to electricity generation.
There's a couple that have come through from a government level. One on the transmission network, how much investment is needed into the transmission network? And the other is, what impact does government policy or lack thereof have on your investment decisions?
Yeah, look, I think regardless of the government policy decision, the relative cost of renewables is such that support from government in terms of subsidies and the like is certainly no longer necessary to build a business case for renewables. Clearly, a bipartisan agreed framework on policy is a helpful thing for any investment decision, and we do see that moving in the right direction with technology roadmaps coming together in the space, which the government has announced, and it looks like some early bipartisan support for that. So I would say helpful that policy is coming together, but unnecessary to make a business case for renewables. The other question was around the transmission network. It is a reasonable requirement in the long term for investment into the grid, and we can see states like New South Wales, for example, looking to commit to those grid upgrades to allow for the additional penetration of renewables. So, they've highlighted renewable energy zones in particular parts of the state, and intend to augment the grid appropriately to allow for that penetration.
Excellent, Neil. That's all we've got for now. Why don't we move on to your approach to the space?
No problem. Thank you. So turning to slide 6 then, and our strategy to address the opportunity. We're focused on wind generation in the first. The reason for this is that the profile of wind generation relative to other renewable generators is attractive. So the profile across the day and across the year of wind generation more closely matches the average profile of demand than a solar plant, for example. So, solar will only turn on in the middle of the day, but wind will blow throughout the day and night, and is therefore able to capture a higher price for the electricity it generates at the time at which it's generating. So we've commenced on this strategy with the acquisition of WindLab. WindLab is a developer and asset manager of wind farms in Australia and in the US and Africa. We're attracted to that business because it has a huge portfolio of quality development assets in this country, and very strong capacity factors associated with those assets and WindLab has already built. And capacity factor means the amount or the proportion that generator is actually producing electricity. And so, for example, can be on a whole for the entire day, and so might operate at a 90% capacity factor. Solar only turns on when it's sunny, so might operate at a 20 to 25% capacity factor. These wind farms are able to attract a higher, 40 to 50% capacity factor, which is attractive to other forms of renewable generation, and also attractive indeed to other wind farms. Part of that additional or strong capacity factor developed by WindLab comes from their IP in a technology called Windscape, which was developed out of the CSIRO, which helps to really map in great detail the wind resource across the country, and that helps then to position a wind farm in desirable locations. WindLab was a listed company. We've recently completed the acquisition to take private that company. Scheme vote and court approvals all came through in the last month. Strategy with the business is to focus in on its large portfolio of Australian development assets, and to bring the capital and commercial expertise required to assist in that exercise. We're really excited by this investment. We feel we were able to acquire it at a good price. We were able to bring in third-party institutional capital alongside Federation investors to make Federation investor dollars go further. We partnered with Andrew Forrest Squadron Energy as a shareholder in the business, and we have a business plan to monetize those non-core parts of the business to leave us with a really attractive entry price into the real substance, being the Australian development assets, and that then leaves us well placed to expedite that pipeline of developments where we've come into those assets at an attractive entry price. Federation investors have already benefited indeed from this transaction. We purchased around a 19% shareholding in the company back in October, and then worked to firm up our proposal to take private the whole company. Our initial stake was purchased at 80 cents a share, and the take private went through at $1. And we think there's a really still a compelling opportunity to drive good returns at that price. Turning to slide 7 and digging in a little further to what WindLab actually does, like what a wind developer spends its time doing. You can see I've laid out a chart showing the phases of the value chain of developing and building a wind farm. On the left there in the green box is the development activity, and then further to the right is the construction and operation of the completed asset. So what WindLab does, prospecting in the first instance, they prospect for an appropriate site with a good wind resource, which means a consistent wind resource and proximity also to the electricity grid. So if you think of this as somewhat like exploration for any other commodity, you want to find a good resource, a large resource, but you also need a way to get it to market. And so a good resource being a consistent wind area, and the access to market being a spot that's near enough to the electricity grid that it doesn't cost too much to transport that electricity to market. So once they've found a good site, they'll continue to verify the wind resource there. They'll embark on entering agreements with landholders, so typically on long-term land leases with landholders to allow the developer to build the turbines there. They get development approvals, development agreements, and also approvals to connect to the grid. They arrange for the wind farm turbine suppliers and the builders of the wind farm under contract, and they contract to sell the electricity that will be produced by the wind farm. It's then at this point that WindLab will sell the project to investors. So once it's been developed and contracted and construction contracts in place, it's at that point that people like infrastructure funds and super funds who have a much lower cost of capital and very long-term investment horizons are the logical owner of that asset. And so the reason that we seek involvement in this development stage is that the development effort can attract much higher PE style returns than the long-term ownership returns. So 25% plus IRRs in that development stage, and compared to 10% type equity IRRs in that long-term ownership stage. So effectively, the developer does this work to deliver and develop the asset to a much lower cost of capital, and takes the up associated with that. WindLab has done a good job of finding lots and lots of sites, lots of options across the NEM, and our focus is on expediting those through the latter phases of the development process to deliver projects. Turning to slide 8, this is an example of the development process with a particular asset. This is called Lakeland Wind Farm in northern Queensland, which is the next asset coming down the WindLab pipeline. This is nearing the end of the development phase. You can see in the photos on this slide, these are photos that I took on my iPhone when we were doing site visits for due diligence earlier in the year. You can see the substation in the left picture where the wind farm will connect to the grid. It's a little hard to see, but in the second photo you can see a Met mast. And so this is a tower that was erected on the site to confirm the wind resource and the nature of the wind resource there. And then all the way to the right photo is the finished product. That's a wind turbine at another of WindLab sites that's been completed. So for this asset, the equipment being used are large capacity Vestas turbines. They suit the nature of the wind resource up in Lakeland. Vestas is a global and credible turbine supplier. The equipment supplier typically performs an operations and maintenance function on a long-term contract where they wrap the performance of the equipment, which is what Vestas is doing here. And the other thing I'd point out is a really important commercial part of the process being the power purchase agreements, which is the contract I mentioned on the previous slide to sell the electricity generated by the wind farm. And you'll see there that Lakeland has contracts with Flow Power and Transurban. So the purpose of that agreement is so that the generator and the user of the electricity can lock in a certain price for that electricity, rather than being subject to the variable price of electricity that happens across the day or across the month or across the years, determined by the wholesale market. And the analogy I use for how those work is to imagine the grid as a big pipe full of water, and the generator adds the water to the pipe up there in North Queensland. Else in the pipe, Transurban will take that water out, and the system keeps track of the amount that the generator put into the pipe and the buyer took out, so that they can effectively pay the contracted price for the amount that's been generated. And the reason that the PPA is typically important is because financiers and the equity investors will want some certainty, at least for a reasonable period of time, over what price the electricity generated will attract. So the PPA is a way to achieve the debt and equity funding of the project. So hopefully that gives you a feel for a real project. Finally, to the next slide, in terms of Federation's next steps, clearly we'll be focusing our efforts on expediting that very large pipeline of projects that the WindLab platform provides, and driving returns for Federation's investment there. We can also see a number of opportunities in other platforms where we can apply this similar logic of development and delivery of assets to long-term infrastructure owners. We can see opportunity in community scale solar, which is smaller scale generators located close to towns and industry across the network, and indeed in rooftop behind the meter solar, and further in developing and acquiring more utility scale assets. We see a really large scale of investment to build all of those projects, with the Federation investor, the investor in that development platform, gaining the benefit of the growth in scale of the platform as it builds over time. So I think that brings me to a close of the slide deck. In summary, we feel it's a really large opportunity set, driven by the nature of the retirement of capacity and how much it needs to be replaced, and also one that's profitable if done well. So thanks, Cam. Maybe turning again to if there are any further questions.
Yeah, there have been a few questions come through. Before we get to them, Neil, I did want to just raise the point with our audience that Federation is in the process of a raise currently that runs through until the end of July. Investors coming into that will be able to access the benefits of Neil and his colleagues' work into WindLab, as well as a number of other assets. Some of those assets we will talk through Tuesday, the 30th of June, next Tuesday at the same time, 9 a.m. Australian Eastern Standard Time. If you're yet to register for that one and would like to do so, my contact details are on the next slide. Please send me an email and I'll be happy to shoot you through an invite. Neil, one of the questions that's come through is, what will you do with the offshore assets of WindLab?
Yeah, look, we do feel like they're probably non-core to the focused efforts of developing out the Australian portfolio. Our plan is to appropriately monetize those assets over time. So whether that be through some initial development in those markets or a sale of those portfolios. And this was, I guess, part of the attraction for us, that we could return some of the invested capital through monetizing those offshore assets, so that we can focus on development of the Australian assets, but also I mentioned, I guess, the entry price of those Australian assets being at an attractive price. So recovering some of our purchase price from the non-core assets, meaning that we've entered the assets in Australia at an attractive price.
Excellent. Thank you very much. How are you pricing electricity at the end of a PPA? How long does the PPA typically run for, Neil, in the first place?
Yeah, PPAs are typically around 10 years at the moment. So typical period of a PPA would be 10 years for a new build generator. The process for determining the power price thereafter, we rely to some extent on technical experts to come up with a view of what the electricity price might look like in that merchant period. But of course, that comes with a higher amount of risk. So effectively, you discount those merchant cash flows at a higher discount rate than you would the cash flows coming from the PPA period. But the methodology for determining that price goes back at a simple level, goes back to that earlier slide where we were talking about the intersection of demand and supply. And so, you have a picture of what demand may look like in 2030 or 2040. You have a picture of what the nature of the generators will look like in that period of time, and that allows you to come up with a view on what that market clearing price will be at each point in future and in each part of the grid.
Excellent. A question on political risks in Africa, question mark. I'm assuming that's relating to the WinLab assets. We did cover off a little bit earlier, but perhaps if you can just touch briefly. We don't need a political history of Africa, of course, but...
Yes,
yeah.
I understand. Look, I think, certainly it's a higher risk jurisdiction and assets there attract a higher return. So when thinking about the value of assets there, they're taking into account the fact that people would require much higher returns on their capital in those jurisdictions than they would in relatively stable political climates like Australia.
Excellent, Neil. We've run slightly over time. Thank you very much for your efforts this morning. Thank you to all of our audience who joined us. If there is more information you require, there's been a couple of requests for the slide deck. We're happy to distribute that around, so just keep an eye on your inbox. We'll send those through later today. And if you do have the opportunity to join us next Tuesday, Neil and I would love you to join us. We wish you a very good morning.